Another reason why this sector may have been ignored is to do with risk. Investment companies can be more volatile than other types of funds. Two reasons for this are gearing and discounts. Investment companies, unlike other funds, can use something known as gearing. Gearing means borrowing money to buy more assets in the hope that the return on those investments will be greater than the cost of borrowing. Used well, it can boost capital growth or dividends. But it comes at a risk. If the investment company's portfolio falls in value, gearing will increase losses. However, you should remember that investment companies tend not to use high levels of gearing, and in fact many use no gearing at all. Discounts refer to the difference between the share price of an investment company and the value of that share's underlying assets. Now, if the share price is below the value of the underlying assets, the shares are said to be trading at a discount. If the share price is above the asset value, it's said to be trading at a premium.
When you're investing for income, you can actually buy a lot of investment company shares at a discount. So that is that the share price that you buy at is cheaper than the underlying assets. So for example, if the share price was 80 pence, the underlying assets might be worth £1, so you will be buying at a 20% discount. But you actually get income on that whole pound's worth of assets.
But if the discount widens during the period you own the shares, you may still make a profit, but the share price performance will be less than that of the underlying portfolio.
When you're buying into investment companies, the share price can be more volatile than its open-ended cousin, because there is more than one influence in there. It's not just the underlying net asset value, there is the gearing or the borrowing, and there is potentially the discount or the premium, and the movement of those things.
It can make for a bumpier ride, but in return, investment companies can offer better long-term returns. That's why the AIC believes they should be part of a client's balanced long-term portfolio.